Imagine a bank with no credible deposit guarantee. You believe it is probably sound, but a rumor says depositors will run tomorrow. If you wait, you may be trapped behind them. If you withdraw, you help create the run. That is rational panic. So how can rational people create irrational markets? A bank does not keep every deposited dollar sitting untouched in a vault. It uses deposits to fund loans and other assets that cannot always be sold quickly without a loss. If everyone asks for cash at once, even a bank with valuable long-term assets can run out of ready money. One depositor withdraws, then thousands make the same calculation. Liquid resources drain, assets may have to be sold at a loss, and the rumor becomes true. This is the uncomfortable logic of a bank run. A reasonable decision for one person can help create a disastrous outcome for everyone. The same logic reaches far beyond banks. It helps explain bubbles, crowded trades, financial fraud, liquidity crises, and moments when a crowd appears to have lost its mind. Sometimes each person is responding logically to a structure that rewards early action, punishes patience, and hides critical information. The result is not individual stupidity, it is collective fragility. The bank run problem begins with a mismatch. Depositors want access to their money on demand. Borrowers need years to repay a mortgage or business loan. A bank connects those two needs. That intermediation is useful, but it also means the bank's promises are more liquid than many of its assets. Under normal conditions, that is manageable because most people do not withdraw at the same time. Under fear, timing changes everything. Without credible deposit protection or emergency liquidity support, the first people in line may receive cash, while those who wait face delay, uncertainty, or loss. Once that possibility becomes credible, running can be privately rational even when the bank would survive without the run. Economists Douglas Diamond and Diamond-Dybvig formalized this mechanism in their work on bank runs. Their model showed why a rumor can become self-fulfilling. A bank can be stable when depositors expect stability and unstable when depositors expect a run. In the self-fulfilling version of the model, the bank's underlying assets have not changed when the rumor begins. Expectations change behavior. Withdrawals then drain liquid resources and may force asset sales at a loss. A fragile system can therefore contain two possible realities, and belief helps select which one arrives. That does not mean facts are irrelevant. Some banks are insolvent. Some fears are justified. The point is narrower. In systems built on confidence and liquidity, fear can damage even an institution whose long-term assets still have value. The individual decision and the system outcome must therefore be judged separately. For the depositor, the question is, how do I protect my money if others run? For the system, the question is, what happens when everyone protects themselves in the same way? Those are not the same question. Why does the behavior spread so quickly? Because financial markets are full of information asymmetry. The people running an institution know more about its assets, obligations, and internal risks than outsiders do. A depositor cannot inspect every loan. A shareholder cannot observe every management decision. A client cannot watch every trade made by a fund manager. We rely on reports, audits, regulators, reputation, past performance, and the behavior of other people. Usually, that reliance is unavoidable. No one can personally verify an entire financial system before making every decision, but incomplete information creates a dangerous shortcut. When we cannot see the underlying reality, we watch the crowd. If respected investors enter, their participation looks like evidence. If depositors leave, their withdrawal looks like evidence. If a price rises, the price itself looks like evidence. Now, behavior is doing two jobs. It is an action, and it is a signal. That creates a feedback loop. One withdrawal increases fear, more withdrawals follow, making the original fear look informed. The same loop can operate in reverse during a boom. One purchase raises the price, the higher price attracts attention, and new buying makes the original purchase look intelligent. At each step, the crowd generates the evidence that persuades the next person. This is why markets can move far beyond the information that started the move. The reaction becomes larger than the signal because the reaction keeps producing new signals. Consider a rising asset that you believe is overpriced. The obvious story says a rational person should refuse to participate, but that assumes your payoff depends only on the asset's underlying value. In reality, your short-term outcome may depend on what another person will pay later. You may think the price is unreasonable and still believe it will rise because other people remain willing to buy. If you exit too early, you may underperform colleagues, lose clients, or look foolish while the boom continues. Participating can feel rational even without believing the story. This does not make joining a bubble wise. It explains why intelligence alone does not end one. A market can contain skeptical participants and still rise. Each person may believe they will recognize the turning point before everyone else. Each may plan to leave while liquidity is still available. But an exit plan that works for one person may fail when everyone shares it. Liquidity looks abundant on the way in and scarce when everyone wants out. An exit plan may look rational only because it assumes most other holders will not try to exit at the same time. That assumption often stays invisible during a boom. Rising prices make liquidity look permanent. Successful exits make timing look easy. The system appears strongest just as more participants become dependent on the same escape route. Then the feedback loop reverses. Falling prices create doubt. Doubt creates selling. Selling reduces liquidity and pushes prices lower. The decline is interpreted as new information, even when part of it is forced behavior. Optimism did not have to be irrational at every step either. The instability comes from the structure connecting those steps. Professional investors face another layer of incentives: career risk. Imagine that a market keeps rising while you remain cautious. Your reasoning may be sound, but the cost of being early is immediate. Clients compare your results with a benchmark. Colleagues question your judgment. Assets leave before the cycle has time to prove you right. Now consider the alternative. You follow the crowd and the market later falls. The loss is real, but the explanation is shared. Almost everyone was exposed. The mistake looks less personal because it has a widely accepted story. This creates an uncomfortable asymmetry. Being wrong with the crowd can be safer for a career than being right alone too early. Again, the point is not that professionals lack intelligence. Their decision may be rational relative to the way performance is measured, clients react, and organizations assign blame. When many managers face similar relative performance pressure, their positions can converge and their exits can become crowded. The market outcome reflects more than beliefs about value. It reflects incentives about survival. People do not always copy the crowd because they believe the crowd is right. Sometimes they copy it because being different is punished sooner than being wrong together. Information asymmetry also helps explain why sophisticated people can be exposed to fraud. Bernard Madoff did not attract money by looking obviously reckless. He had status, industry experience, influential relationships, and a reputation for exclusivity. His reported returns appeared unusually smooth. For many clients, those signals reduced the perceived need to ask harder questions. Fraud is not a bank run, but the signal problem is similar. Each respected investor can become evidence for the next. The trust was assembled from credentials, social proof, consistency, and restricted access. That is how a weak signal can become persuasive. Each element appears reasonable on its own. Together, they create an aura of verification without producing actual transparency. Documented red flags existed. Warnings reached the SEC years before the collapse, and the SEC later acknowledged serious examination failures involving implausible trading claims, secrecy, and return patterns. The lesson is not that trust is irrational. Finance cannot function without delegated trust. The lesson is that reputation is not the same as observability. When verification is expensive, people substitute signals. Prestige stands in for transparency, consistency stands in for proof. Other investors' confidence stands in for independent examination. That substitution can be efficient. It is also exactly what sophisticated fraud can exploit, so the right question is not, why did anyone trust him? The better question is, which signals were treated as proof, and what evidence could not be independently checked? Structure explains why instability is possible. Psychology helps explain why it becomes powerful. Overconfidence makes us believe we will leave before the crowd, identify the good manager, or distinguish skill from luck. Large retail account studies associate heavier trading with lower net returns, partly because transaction costs compound. Overconfidence matters here because it makes each participant believe they can exit first. The disposition effect creates another distortion. People tend to realize gains sooner than comparable losses. It becomes a bias when the purchase price, rather than updated evidence, drives the decision. Limited attention adds a third force. Complex systems produce more information than anyone can process. We focus on what is vivid, simple, recent, and easy to name. A dramatic headline receives attention. A smooth performance chart receives attention. A rising price receives attention. Quiet balance sheet details often do not. None of these biases needs to control every participant. That is important. Markets do not require universal delusion to become unstable. A modest bias can be amplified by leverage, incentives, imitation, and feedback. A small error in judgment can become a large market move when the structure rewards copying. This is why explanations based only on greed or fear are incomplete. Greed describes a motive, fear describes an emotion. Neither explains why one person's action changes the incentives facing the next person. To understand the outcome, we need both levels of analysis, the mind and the mechanism. This leads to a practical framework. It is not a method for predicting prices or choosing investments. It is a way to diagnose a system before a crowd becomes a crisis. First, ask, what is the privately rational action? Do not begin by judging the participant. Reconstruct the incentives. What does the person know? What can they not know? What do they gain by acting early? What do they risk by waiting? If you cannot explain why the behavior makes sense from inside the situation, you probably do not understand the behavior yet. Second, ask, what happens if everyone copies it? A decision can be sensible at small scale and destructive at large scale. One depositor can withdraw safely. Every depositor cannot. One investor can sell into a liquid market. Everyone cannot sell at the last quoted price. Scale changes the nature of the action. Third, ask, which feedback loop makes the action look smarter as it spreads? Does a higher price attract more buying? Does a withdrawal create more fear? Does a prestigious investor attract other prestigious investors? Does short-term success increase risk-taking? The most dangerous loops reward the behavior before revealing its cost. Early participants look intelligent, which recruits new participants and strengthens the loop. Fourth, ask, what would make the stable action individually defensible? Warnings alone are often weak because they ask individuals to accept a private disadvantage for a public benefit. A depositor will not remain calm merely because calm is good for the system if waiting could cost them everything. Effective safeguards work through different channels. Deposit insurance changes incentives by reducing the reward for running first. Better disclosure improves information. Independent custody strengthens verification. Pre-committed decision rules strengthen discipline when emotion changes the standard of evidence. The common purpose is not to make people morally better. It is to make the stable action individually defensible. That is a more realistic standard for judgment. Markets are often described as machines for combining information, but they also combine incentives, uncertainty, imitation, and emotion. That means a market can be filled with intelligent people and still produce an unintelligent result. Intelligence helps a person optimize inside a game. Judgment asks whether the game itself is stable. So the judgment principle is this: never judge a system only by whether each participant's decision makes sense. Ask what happens when the same decision is copied at scale under uncertainty with feedback. Return to the bank at the beginning. Withdrawing may protect one depositor. It may also help destroy the outcome that made waiting safe. Both statements can be true. That tension is not an exception to rationality. It is a warning about structure. The next time a market looks completely irrational, resist the easy conclusion that everyone has become foolish. Look for the private incentive, the missing information, and the first mover advantage. Then look for the loop that turns one reasonable action into evidence for the next. The crowd does not have to be irrational. It only has to be rational inside a fragile system.